more like systems that kind of reveal themselves. So let's pretend you don't have a hedge fund and you come down from Mars and you have to start a portfolio from scratch. How do you anchor it at this moment in time? What do you buy first?
That's a hard question. Just a couple principles before I would start. It appears to me the U.S. economy is already strong, and it's going to get much stronger because we're looking at the big, beautiful bill, looking at a lot of stimulus. My guess is the Fed is certainly not going to hike and probably going to cut. So that's a backdrop. But against that backdrop, that would be wonderful if we were undervalued. We're not undervalued. We're toward the top of the valuation range historically. What would be exciting about developing a hedge fund portfolio right now is the one thing I'm sure of is there's massive disruption and massive change ahead. So actually for the opportunity set for the next 3 or 4 years, I'm really excited. Macro has been dead for 10 or 15 years. I don't think that's the case anymore. If you know anything about me, I tend to change my mind every 3 weeks. But given the backdrop, we would probably be long more an eclectic basket of equities. For until the fall of the last 3 years, our portfolio was very much AI driven.
Mm-hmm.
We still have drips and drabs of AI around, but it's not driving the engine anymore to some extent. We still have big positions in Japan and Korea. Some of them are AI, some of them are not. We're bearish on the US dollar, mainly because sort of the top of the historic range in terms of purchasing power. And foreigners are way, way overloaded in dollars. And I don't know whether it's like a sell America trade because it's more like if they don't buy American assets on a net basis because of the trade balance and because of the positioning, the dollar will go down on its own. And we think that is the most likely course here. And we own copper. It's not a genius trade. It's a big consensus trade. There's no supply coming on, a meaningful supply, very tight for the next 8 years. And obviously you have a big add-on from AI and data centers. We're not long copper equities as much as we are. We just keep rolling the front end. We have some gold. That's mainly a geopolitical trade. It's not so much a monetary trade. And then because we're long all these risk assets I just mentioned, we're short bonds. I don't necessarily expect to make money short bonds, but I think we might make a lot if I'm right on the economy and it's a disinflationary growth. I probably break even and I don't lose anything, but it allows me to hold the other assets I mentioned. If I'm wrong and the strong growth creates inflation, it wouldn't be that unusual if the Fed were to cut into a booming economy for inflation to take off, particularly with what's going on in commodities. So I'm open-minded to that. But we create a matrix, and the bonds are helpful in both ways.
The equity market has changed a lot.